When most people decide to enter the stock market, they are looking for a quick payout. They pull up complex charts, watch red and green lines spike and crash, and try to predict short-term price movements. This approach is known as technical analysis. The problem is that predicting minute-by-minute market fluctuations is incredibly difficult. Because it relies almost entirely on guessing short-term price action, the failure rate for this strategy is staggering. This chart shows exactly how high that failure rate is. Over 95% of day traders actively lose money rather than making it. This represents a massive pool of capital lost to short-term speculation rather than long-term growth. To actually build wealth over a 3 to 10-year horizon, you have to abandon the daily charts entirely. Instead, you need a strategy called fundamental analysis. Fundamental analysis means becoming a detective for a company. When you buy a share of stock, you are buying a partial ownership stake in a real business. You treat the purchase like you're entering a long-term partnership, checking their past behavior to ensure they are reliable. By digging into how a company operates and how much cash it actually brings in, you shift the focus away from pure luck. Relying on an objective investigation provides a data-driven foundation that simple chart patterns cannot match. To run that investigation, public companies are required to publish their exact financial records. There are 3 core documents every investor must check. Let's use an established giant like Coca-Cola to see how this works in practice. The first document is the balance sheet. It provides a snapshot of the company's financial position at a specific moment. The most important metric here is comparing current assets, cash or inventory they can use within 12 months, against current liabilities, which is short-term debt they have to pay back within a year. You can determine if a company is high risk by dividing total current assets by total current liabilities. A healthy company should have a score above 1. Coca-Cola has $26.7 billion in assets and $23.5 billion in liabilities, giving them a safe score of 1.13. They have more than enough cash to cover their immediate debts. Once you know they can survive the year, you check the income statement. This acts as a report card over a set period. It takes the total revenue the business brought in and subtracts the costs of making the product and running the company. What's left over is the operating income. This diagram shows the typical benchmarks for a company's profit margin. You find this percentage by dividing operating income by total revenue. 5% is considered a low margin, 10% is healthy, and 20% is a high margin. Coca-Cola generates an operating income of $10.7 billion against $45 billion in revenue. That puts their profit margin at roughly 25.7%, easily passing the test for high profitability. The final document is the cash flow statement, which tracks exactly how money moves in and out of the business. You want to see positive cash coming from their daily operations. If a company is constantly taking on debt just to pay out cash rewards to their investors, they will eventually run out of money. Analyzing the balance sheet, the income statement, and the cash flow statement is the only objective way to verify a company's health. It separates strong, profit-generating machines from businesses trying to hide structural financial decay. But financial data alone isn't enough to guarantee a safe investment. A company might have flawless spreadsheets, but still fail because they lack the real-world traction necessary to survive in a competitive market. The first unquantifiable factor you need to evaluate is brand recognition. An established base of loyal customers minimizes your risk. For example, almost everyone in the West knows and trusts Apple. But if you look at the Chinese tech company Xiaomi, despite being a major global player, they have very little brand recognition among Western consumers, making them a much riskier hold. The second crucial factor is executive leadership. You're trusting the board of directors and the CEO with your money. An erratic leader with a massive public platform can wipe out corporate value in a matter of seconds. In December 2016, Donald Trump sent out a single post on Twitter criticizing a military contract's rising costs, stating that billions needed to be saved. The target of that post was the F-35 fighter jet program run by Lockheed Martin. As investors reacted to the sudden political pressure, the company's stock fell by 2.5%, erasing nearly $4 billion in market value in a single day. The final intangible to check for is a competitive advantage, often called a business moat. This is something the company has that competitors cannot easily copy. Tesla, for instance, secured an expansive proprietary charging network. That infrastructure acts as a physical moat, protecting their market share from other automakers. Solid leadership, deep consumer trust and clear competitive advantages act as a buffer against market threats. While spreadsheets calculate past performance, these intangibles help determine which companies have the structural strength to withstand future pressure. Doing the structural research and evaluating the business model is only half the battle. The other half is cultivating the emotional discipline to ignore the constant noise of the 24/7 financial news cycle. Sensational headlines naturally cause panic, pushing amateur investors to abandon strong companies over temporary setbacks. In March 2018, news broke that user data had been unethically harvested in the Cambridge Analytica scandal, causing massive public backlash against Facebook. This line chart illustrates the market's reaction. Fear-mongering drove Facebook's stock down nearly 18% in just 10 days. But investors who trusted their original fundamental research held strong, and the stock eventually recovered, climbing more than 200% in the following years. You should only sell a stock if you hit a personal financial goal, find yourself in an emergency, or realize the company's core fundamentals have permanently broken. Selling in response to short-term headlines often locks in losses just before a market recovery. Once you have the research skills and the discipline, you need to structure your actual portfolio. Generally, individual companies fall into two distinct categories: value stocks and growth stocks. Value stocks are massive, stable companies that people rely on regardless of the economy. They generally have a price-to-earnings ratio, which compares the stock price to the company's actual profits, under 20. These are often businesses providing everyday consumer staples, like Procter & Gamble, and they routinely pay out regular cash dividends to their shareholders. Growth stocks operate differently. They are volatile, rapidly expanding companies with high price-to-earnings ratios. Instead of paying dividends, companies like Amazon take every dollar of profit they make and aggressively reinvest it back into building more warehouses, hiring more staff, and expanding their footprint. To protect yourself against sector-specific crashes, you must diversify. The golden rule is to never put more than 5% of your total money into a single stock. A safe, resilient portfolio spreads its investments across at least 5 different industries and holds a minimum of 25 different companies. If running balance sheet calculations and monitoring CEO behavior for 25 different companies sounds too exhausting, there is an alternative. You can buy into broad index funds, which automatically bundle hundreds of strong companies into a single, pre-diversified package. Whether you pick individual stocks or use index funds, the formula remains the same. By combining rigorous fundamental research, cold emotional discipline, and strict portfolio diversification, you stop acting like a blind gambler and operate as the architect of your own wealth.